All right, welcome. I'm Loren Keim with Lehigh University's prestigious Goodman Center for Real Estate, where we both educate the next generation of real estate industry professionals and where our faculty scholars are actively engaged in research, regularly publishing in the top academic real estate journals. We are truly honored today to have such a distinguished panel of several of the creme de la creme, the country's top experts in commercial real estate research and analysis with us today. An old proverb you probably have all heard is that may we live in interesting times. And I cannot imagine a more interesting time than 2020. Yesterday, Philadelphia again closed down interior dining. New York is limiting Thanksgiving celebrations to 10 people in private residences, and the number of COVID cases is hitting record numbers. 2020 has brought us the most significant pandemic the last 100 years. It's brought us a contentious election that may result in some pretty significant changes to 1031 exchanges and the sale of real estate assets. And it's brought us some technological innovations that are changing the way we work. There are residents of major cities fleeing for suburbia. There are retailers being brutalized by quarantines and landlords that are feeling their pain. There are office towers in central business districts that appear almost empty because so many employees are working from home. But of course, with any change comes opportunity. So one of the questions we're going to discuss today is how does all of this impact the world of commercial real estate? And with us today, I'm humbled and honored to have Spencer Levy, the chairman, America's Research and Senior Economic Advisor for CBRE. I have David Seaman, a partner with PwC. I've got Sarah Dreyer, Vice President, Head of America's Research for Savills. Surabhi Kejriwal, Assistant Vice, and I apologize, I'm going to keep butchering that, Assistant Vice President, Real Estate Research Leader for Deloitte, and Ken McCarthy, the Principal Economist, America's Head of Applied Research for Cushman & Wakefield. If it's acceptable, I'm going to introduce our panel alphabetically by last name, which means the first person is Sarah Dreyer, who again is the Vice President, Head of America's Research for Savills. Sarah leads all research and GIS operations and always delivers cutting-edge insights and data. And by the way, she was listed as one of Washington Business Journal's top 40 under 40. Sarah, you have some unique insights into tenant demand and on technologies being used to adapt to today's environment. Can you take us through your market outlook during and beyond this pandemic?
Yeah, absolutely. And thank you so much for having me join today. It's really wonderful to get to come and share my perspective with you. As you mentioned, yes, I do oversee the America's Research and Data Platform at Savills. And with that, that's really tracking the market and working closely with our client technologies teams to help our professionals and clients make better informed real estate decisions. For background on Savills, Savills is a global real estate advisory firm that helps organizations find the right real estate solutions through a team of integrated brokers and consultants. We do specialize in tenant representation as well as workplace strategy, project management, workforce incentives and strategy, capital markets, and working so closely with occupier clients. My views on the market, they're really coming from that tenant-focused perspective, and that's what I'm going to share with you today. So as far as what we're seeing in the market right now from the tenant's perspective, what I see is that the state of the markets, it's really greatly categorized by a pandemic pause. We were all, whether we liked it or not, thrust into this unprecedented environment in March. And there's just still so much ongoing uncertainty on so many fronts, to your point that, that return to work, it's really mostly everyone's still working from everywhere. And most organizations that don't need to be making real estate decisions right now aren't. They're either pausing leasing searches or delaying until there's a clearer path forward and clearer return to office forward. So this pause, it's manifested in the market statistics in a number of ways. First, what I'd say is we're seeing a total pullback, drop off in leasing volume across all major cities in the US. Year-to-date activity for the US, it's down 36% compared to the first through third quarters of 2019. And then when we drill down even further and we looked at the third quarter of this year alone, activity was down close to 50% when you compared that to what happened in Q3 2019, looking at all deals, new leases, renewals, everything. The leases that are happening right now, they were either set in motion well ahead of the pandemic and are kind of getting pushed across the line, incentivized by rental rates dropping or an increase in concessions. But outside of that, what we're really seeing is a lot of extensions, short-term renewals, while companies are taking the time to regroup on their space priorities and their strategy going forward. With this, we're also seeing a surge of sublease space come into the market across the U.S. as organizations, continue to be focused on reducing costs. We're seeing companies shedding space that they're not using right now in the current environment, or may not need going forward, in order to save money while working through future space needs and planning. With that, sublease availability in the US, it's hit historic levels in many major markets like San Francisco. That stands out to me. I think it's almost doubled, tripled in San Francisco, the amount of sublease space that's coming to market, as well as markets like Chicago, LA, New York, with more coming online every day. And with this, we're naturally seeing availability rates, vacancy rates rising across all of our markets. But for tenants, with that opportunity, absolutely, it still exists. With these markets softening and owners becoming much more flexible with terms and more generous with the concessions that they're offering in the current environment, this time and the foreseeable future really is ripe for opportunistic tenants to capitalize on some of the fallout that we're seeing. And I'll close this by noting that the impact of the office market, it's definitely being felt differently market by market. Our denser, more transit reliant markets like New York and Chicago, and we talked about this a bit just now pre-call, that's going to be harder for return to work scenarios, just given the hesitation to use public transportation right now, as well as those cities where businesses have just been completely halted by the pandemic, like San Francisco, Silicon Valley. It's going to take longer for these cities to bottom out, and they're going to have a more medium to long-term recovery timeline on the other side of the pandemic. Then on the other hand, we have markets like DC that are really bolstered by a strong government presence, or those that have a lot of healthcare or life science companies. Those markets have not seen as sharp a drop off in activity. So less dense and high quality of life secondary markets, I'm thinking those like Atlanta, Charlotte, Raleigh, Tampa, they're becoming increasingly attractive to companies and organizations. They're likely to see the bottom faster in this and a much quicker recovery on the other side. So the office sector, it's certainly going to have a bumpy year ahead, but I'm here to say it is far from dead, despite what you hear, despite what you read. Work from anywhere, it's going to be more prevalent going forward, but so will the focus on the office as collaboration, gathering, and meeting space. That shift of how we view the office space is going to change. Innovation, it happens when teams and people are together. And one thing that I've learned is that's, with my teams and my colleagues, that's something that we just can't replicate as well in a virtual environment.
Thank you, Sarah. That's fantastic information. Before I introduce our next panelist, we're going to put up our first poll question of the day. And this is for the audience. And hang on a second. Oh, you got the poll question up already. That means all of you have the opportunity to chime in with your thoughts, and we try and make our polls a little entertaining. So the first question is, do you believe the majority of employees will be back in their offices by mid to late 2021? And you can answer yes, yes with more social distancing, no, or it doesn't matter because the zombie apocalypse is right around the corner. So please feel free to fill that in. And actually, people have picked the zombie apocalypse. While we're doing that, I'm going to move on to our second panelist today. Surabhi Kejriwal is the real estate research leader at Deloitte Center for Financial Services. Surabhi is a significant contributor to annual real estate industry outlooks and simply a wealth of information. Surabhi, I've actually read your article on robotic and cognitive automation in real estate and an article on smart city initiatives, which were both great. You seem to have written quite a bit about the changing face of real estate and the growing importance of technology. Would you be able to give us your perspective on how that fits into what we're likely to see after this pandemic and going forward?
Yeah, sure. Thanks, Kim. I have, by way of quick introduction, just an extension of what Loren just mentioned. I am largely focused on developing content that helps Deloitte differentiate its voice in the digital transformation and technology space in real estate. I focus mostly on US real estate with some coverage of the global real estate marketplace. And especially when we look at the whole technology piece as it relates to real estate, it kind of cuts across geographies. Some of the trends, and especially I think the current pandemic has really, while it's isolated each one of us, it's kind of brought the world much closer in the sense we've all become virtual. We are all equally accessible to each other across the globe. And this session is an example of the same. I'm based out of Mumbai and I'm doing this panel along with most of you who are based out of the United States. So I would say 2020 really has been the most memorable year in recent history as it relates to the impact of COVID on the global economy, on the commercial real estate industry. Companies have had to digitize operations, had to close physical facilities due to extensive lockdowns, prepare for reopening while ensuring the health and safety of employees, occupiers, and also considering the financial health of tenants and end users. We believe that given how 2020 has emerged so far, 2021 could be even more monumental, given that the critical decisions and investments leaders would make now would come to fruition over the next 12 months. And just building on what Sarah mentioned, we've kind of seen a dichotomy in the way COVID has impacted various property types with industrial, data centers, cell towers, healthcare actually being positively disrupted by the pandemic, whereas office, hotel, and retail continue to feel the pressure. Now, from a technology perspective, we feel that three things that are really going to differentiate companies in the long term and help them to not just recover, but position themselves to thrive in the long term are emphasis on technology and digital transformation. Instead of taking a piecemeal approach to implementing technology in your organization, how are companies looking at having a more structured roadmap on implementing digital technologies throughout the organization? This would also involve use of data and analytics to make more informed decisions as it relates to tenants, as it relates to end user preferences. And finally, with the increased virtualization, there's just more spotlight on cybersecurity and data privacy. The second piece would be revisiting the value proposition of real estate, especially in case of office space, something we're going to talk about more and dig deeper into it. Like more and more companies are rethinking about how and when they use the office space. Offices are likely to be reserved more for face-to-face interaction, team-based activities, and enhancing collaboration and innovation. And employees are likely to continue to work from home for more individualized tasks and assignments. In fact, Deloitte did a survey of millennials in 2020, which had 9,100 respondents. And in that, more than 60% of respondents say they want an option to work remotely more frequently, even after the pandemic. Nearly as many said they would prefer to use video conferencing instead of traveling for work. Telling statistics, right? Given that we expect more millennials to occupy our workspaces going forward. Now, at the same time, the other challenge that's facing office owners is the increase in cost due to implementation of health and safety measures. We did an analysis some time back, and our model forecasted that companies are like office owners are likely to face an increment in operating costs by at least $19.4 per square feet, or 5.8% of average annual office rents at the beginning of 2020. We also are seeing a shift in market dynamics. This is a no-brainer. Sarah touched upon this, that how people are going to continue to avoid overcrowded cities like New York, San Francisco. We are seeing an uptick in subleasing trends, and this has created significant uncertainty, not just around, which space is going to be more in demand. There are questions around whether satellite offices will pick more space compared to high-rise towers, but in general, there is uncertainty around property valuations and premiums associated with Class A properties, not just in the US, but globally as well. The other two areas which we feel are central to this discussion would be the financing situation. Fortunately, the real estate industry has much stronger financials, unlike the global financial crisis. Average rent collections have been above 90% for industrial, office, apartments, and healthcare REITs during the April to July 2020 period. However, there is growing caution as the industry continues to lag the economy when it comes to the impact of the pandemic. And last but not the least, I think for the real estate industry, the whole focus on talent has been accelerated as many organizations have to revamp job roles, recruiting strategy, talent systems and processes, and culture to attract and retain a multi-generational workforce. So I think while we stay very focused on market fundamentals, occupancy rates, and whatnot, or how much are properties attractive to investors, but really talent is what's really going to differentiate an organization as they look at positioning themselves for long-term success. So I would say the next few months are going to be turbulent and will require a different level of engagement, agility, and flexibility between the landlord and the tenant to recover, adapt to the next normal, and thrive.
Well, thank you, Surabhi. I appreciate it. If you didn't see the results from the last poll, it's interesting. About 70% of the respondents that are in the audience think that we're going back to offices one way or another, but 28%, close to a third, believe we're not. And of course, there is that 3% that thinks we're looking for the zombie apocalypse. As we move to our third panelist, Shannon is going to put up our second poll question for viewers, which is, do you believe the pandemic, I just lost the questionnaire, there we go. Do you believe the pandemic will lead more corporations to relocate to more suburban markets? Our third panelist, while you're answering that question, and it looks like a lot of people are tuning into that, our third panelist, Spencer Levy, probably doesn't need an introduction from me. He's chairman, Americas Research and senior economic advisor for CBRE. Mr. Levy, you have obviously spent quite a bit of time in the media providing market commentary on nearly everything real estate related. I've seen some of your interviews on CNN and CNBC. I know you've spoken extensively recently on companies rethinking office space and on workers coming back to the office and how all of this is going to impact values. At this point, you have the floor. Where do you see everything going?
Well, before I begin, I'm with those 3%ers on zombie apocalypse because there was a terrific movie in the late 2000s about just that. And somebody said they had the cure for cancer. Everybody got a shot and half of America turned into zombies. So not impossible, but outside the range of our worst case scenario. The other thing I would say is that Sarah, and I don't want to mispronounce your name, Surabhi, did a fantastic job. And there isn't much I can add to what they said, except for this. And this is the one that's going to be the tough pill to swallow. What Surabhi and Sarah and what we do is survey people today and ask them their opinions, not dissimilar to the poll you just put up there. And I say this with respect to people filling out surveys. I say this with respect to CEOs that get on Squawk Box and say they're not going back to the office or don't need to send their employees there. But I'm an early 1980s music fan. And one of my favorite bands was called Asia, and they had a song called Heat of the Moment. And what does that mean? It means that people filling out surveys today, the very same people of good faith, are going to answer differently 6 months from now when we are out of the apocalypse. So anybody who reaches any definitive conclusions today on the percentage of the office falling down, the percentage of people moving from CBD to suburbs, the percentage of people moving from New York, San Francisco to Raleigh, Nashville, Charlotte, Dallas, I think that they are getting a little bit ahead of themselves. Because the bottom line is this: the future of office looks more like the past than anything else. Now, there will be changes, and we just discussed some of those changes as relates to urban, suburban, as it relates to the geographic location, as it relates to increasing the wellness of these buildings to the same level that we increased their security post 9/11. But it is too soon to read these surveys and say, aha, I have the answer, because nobody has the exact answer, because people are making decisions under what you would call, for legal terms, duress. Back to you, Loren.
That sounds actually great. And we do have polling results from the last one. Right now, about 61%. And I understand what you're saying completely about the fact that when you're in the moment, things change. And I love Asia as well. 61% of respondents believe that it will lead to more corporations relocating to suburban markets. And 31% say, no, you don't think so. And 8% have absolutely no idea what's going to happen next. Before I introduce our next panelist, Shannon's going to put up our poll question number 3, which is, what do you believe will happen with the value of retail and office properties over the next 24 months? And retail is an interesting problem at the moment. So our fourth panelist Boy, I am having problems here on the computer. Our fourth panelist, Ken McCarthy, is a principal economist, America's head of applied research for Cushman & Wakefield. And prior to that, Ken served as the chief economist for the Center for Innovative Entrepreneurship. He has a wealth of knowledge. He has personally helped me on numerous occasions to understand data and trends. I've known him for a while. Ken, I know you're an expert on office markets across the US and on leasing performance. I'd love your take on what's happening, and also, what do you think of this urban-suburban shift that we've just been talking about, and whether or not there's any validity to it?
Okay, well, I'm in a worse spot than Spencer, because now I have to follow three people who did a really good job, and which gives me less to say. I happen to agree with Spencer very much, having lived through 9/11 in New York City, when everybody thought downtown was dead and no one was going to be working out of the top of a building anymore, and how much, obviously, how wrong all that was. I do think that in the end, we're a social animal, and we like to be together and work together. What I'd like to do is talk a little bit about the economic recovery here, because I think one of the things that's remarkable about the situation we're in right now is the speed at which it's happening. This recession was, without a doubt, the worst in history in many ways in terms of job loss in particular, but it was also the shortest. And in my view, the recession lasted 2 months. It was March and April. Since then, employment has been growing, the economy has been growing, the GDP has been growing. All the things that you expect to see in a growing economy are happening. So what we're in is the recovery. And to give you a sense of how fast that is, let's take a look at the global financial crisis back in 08, 09, all right? The recession lasted a year and a half. Okay? The economy lost jobs from the beginning of 2008, really until the beginning of 2010, 2 full years, right? We lost jobs for 2 months. We're already in a recovery. And people are talking about it's not going to fully recover for 3-4 years from now. In the global financial crisis, it took 6.5 years to get back all the jobs that were lost in the recession. So we're working at a very accelerated rate. And I think that's having a lot of impact on a lot of things, including real estate. And I think we can talk about that a little bit more going forward, how many people are going to work from home, how that's going to work out. You know, COVID is a bit of an accelerator. It's causing trends, I think, that were already in play to happen a little bit faster. But in the long run, it's really going to be about demographics. It's going to be about those boomers who listen to the Grateful Dead like I did, or those Gen Xers who listen to Asia, and also, of course, to the millennials who think everything revolves around them. Those are going to be the key drivers of what happens to real estate long term.
Thank you very much. The latest poll, if you can see that, we've got 60% believe that property values for office and retail are going to decline by 10 to 20%. 26% think the property values are going to recover most, if not all, the value. Very small percentage think we're going to go into a V-shaped recovery on it. And about 8% think we're going to decline more than 20%. And about 2% were busy on TikTok. So our next poll question, I believe, before I introduce our final panelist, we're going to put up, and Shannon has done that. What is the most challenging aspect for you if you work from home? Got a lot of interesting answers that you can answer there. And our final panelist to speak first, then we're going to go into a discussion, is David Seaman. He's a partner in New York of PricewaterhouseCoopers, PwC. He does extensive work in the real estate business advisory services, David had told me last week that he's having daily conversations with clients about their performing or not so performing real estate assets. And PwC just released, in partnership with the Urban Land Institute, their annual Emerging Trends in Real Estate report for 2021, which I know you're involved with. Do you agree with the other panel members so far, what they've said, and what are your predictions going forward?
Thanks, Loren, and thanks other panelists for sort of doing my job by giving the full view of what's happening in real estate. So I really don't have anything to add. So I'll just say goodnight. And no, I won't. I got plenty to say. So what I'd like to do, Loren, is maybe just rather than repeat some of what I heard from my erudite panelists. And I agree with Spencer that surveys, it's hard to survey people in the middle of an absolute economic meltdown, which is what we had this summer and what we've been living through for the last 9 months. What I would like to do, though, is the Emerging Trends Report, which we just literally published a matter of weeks ago with the Urban Land Institute, identified 10 trends for 2021. So I'd like to kind of touch on those quickly, because I think they're relevant, hopefully, to the discussion we're going to have. And I think they're relevant not only to the office sector, but more broadly to what's happening in real estate as a whole. So the Emerging Trends Report is a report we've published for over 50 years, and it's meant to be predictive. Again, it's hard with surveys when things are happening in the moment to extrapolate those to the future. So we try to look at more longer term trends and not get caught up in what's happening in the moment. Because I agree with Spencer, there are times when people respond to surveys and they're looking out 6 months, not 10 years or 2 years or even 1 year out. So some of the top trends that we identified is definitely work from home is a trend that got accelerated and is here to stay. That doesn't mean that nobody's going to go back to offices or that the office sector is going to collapse. And we could talk about the nuances of that. And one of the interesting outcomes from our survey is we asked survey respondents, are you going to need more office space 3 years from now than you have currently? And 51% of the respondents said we want to have more office space 3 years down the road than what we have now, which again, may be counterintuitive when people think about working from home, killing the office sector and creating a real collapse in demand for office space. So the good news is offices are still relevant and will be in the future. That was one of the first trends that we talk about in our report. The second trend we talk about is migration. Again, Spencer touched on it. Are people leaving the Northeast to go to the Southeast? Are people leaving the high cost cities to go to lower tax environments? And the answer is, yeah, that's a trend that started and has continued. It is a secular trend. It's not a something that's happening right in the moment. We've identified this for the last few years. There is some objective evidence that indicates that people are bailing out of California to a certain extent to go to places, lower tax states like Texas and Austin and Nashville and places like that. Although, again, it's important to note that California still is a very robust economy and is a technology hub that will continue to be an innovative hub. So we're not saying the state of California is dead, but we are saying that there is movement from the Northeast to the Southeast, and there's objective evidence that there's still plenty of movement from California to lower tax states like Texas, Nevada, Utah, and places like that. Another trend, quickly, we talk about the exodus to the suburbs. And again, this is a trend we identified previously as, we identified there are suburbs called hipsterbia. So these are suburbs that are close into the cities, may not be within city limits, but are places that people are moving to because they have a lot of the amenities that people can get in the city. Great restaurants, great culture, and all of those types of things. So while we don't necessarily believe that offices are going to bail out and suburban office is going to become hot again, we do think there is a trend and acceleration of people potentially moving to the suburbs. And the millennials, you talk about the millennial generation, the oldest millennials are turning 40 nowadays. So they are raising families in the suburbs and are moving out of the cities, but they're being replaced by the Gen Zers and others who are in their prime years to live in the urban environment. Other trends, I don't want to go through all of them, but retail. We talk about kind of the evolution and the acceleration of investment in industrial properties as kind of the new retail. Amazon needs locations that are close to their customers and being able to ship, within the day. So there has been an enormous uptick in industrial that we've seen. Again, it's a trend that's continued over the last 5 years, but it's accelerated. And with the disruption of trade and the disruption to supply lines, industrial is getting even more focus because people need to have goods on hand nearby as opposed to just-in-time inventory, which was kind of a concept that was in vogue 5 to 10 years ago. So industrial is getting its day. It's the hottest asset class in real estate right now. But retail, let's not forget that 85% of retail is done in stores. 15% is done online. It's increasing and definitely is a trend that is accelerating, but retail is going to get repurposed, and there's still too much of it, but stores still matter, and retail is still a place that people will go to shop. I'll kind of leave it there. There's many more trends that we could talk about, and hopefully in the context of our office discussion, we can touch on some other trends. But what I would say in kind of wrapping up my remarks is that we are fortunate in the retail sector, in the real estate industry, that we have a lot of participants that have a lot of dry powder. There's a lot of people who are interested in investing in real estate. There's a lot of people around the world who still find the US to be a compelling place to invest their funds. We believe that real estate, while it may have some temporary valuation shocks, and certainly in the hotel sector, in the mall sector, in various forms of CBD office, we are seeing valuation declines. Some as extreme as 25 to 30%, less so in multifamily and industrial, where values may even be going up right now. We still believe that real estate has a great long-term investment thesis for the future, and we will continue to be attractive to private equity players, as well as sovereign wealth funds, as well as retirement funds throughout the United States and endowment funds. So we're bullish on real estate in the long term. We're going to go through some shocks in the near term, but again, there's a bright future ahead. So I'll leave it at that, Loren, and look forward to having a panel discussion.
Well, thank you, David, very much. Actually, any type of challenge in a marketplace obviously creates opportunity. One of the most recent poll we have, just put up the results. The most challenging aspect of working from home, surprisingly, 6 out of 10 of you picked lack of socialization. And 31% said switching off, being able to actually stop working at home. The final poll question we have for you today is, what would it take for you to feel comfortable in your previous work environment? And the first answer is a Starbucks in my office. So trying to open this as a discussion between all of you, since we've got such an incredible panel here today. You all have said very much the same things, but do any of you want to predict when we'll see the bottom of the impact of this crisis in commercial real estate? When we'll see the press start worrying less and we'll see people moving back into that office space? Is it going to be possibly this summer? Are we looking at the end of 2021, or what are we looking at as where we can call the bottom? Any ideas?
Goldman Sachs came out and said that that every American will be vaccinated by the end of June. I'm going with shortly
June,
after that.
July.
Or July.
Second half of the year, for sure.
Yeah.
I hope they're right.
Yeah, so I'm going with that. And it better be then, because the real challenge we have isn't office, it's multifamily in these big cities. Multifamily is falling off a cliff. I mean, it is. I mean, look, the facts on the ground on multifamily in New York and San Francisco are far worse than the cover statistic. I got a buddy of mine in Long Island City who was offered 3 months free rent just to renew. And it's shocking what it is, what they'll do to maintain face rent. So I say July, and I'm also the guy who said zombie apocalypse, so let's go with that.
It's funny, you mentioned people moving out into the suburbs again. I'm obviously in Eastern Pennsylvania, And we're seeing so much movement into the Pocono Mountain marketplace. There were statically about 2,800 homes for sale over the last few years. And currently, I think it's under 700. Properties that are coming on the market are selling instantly. Prices are rising rapidly. And it's all people that were tenants in the New York metro area that are moving out further and further. And obviously, it's not just the Poconos. It's Connecticut, it's Long Island, it's anything that's outside.
Can I make one more point? But that's just residential. And I'll give you one case study. And the case study is this. Back in the late 1990s, two large European banks, RBS and UBS, both made the same decision to put their new headquarters in Stamford, Connecticut. Right. And they did it because they were thinking, well, this is the perfect solution. Well, right on the train line, 40 minutes to New York City, our younger professionals can reverse commute and our older professionals can drive to the office. Well, yet that went over like the proverbial Led Zeppelin with the younger professionals. They could not attract or retain talent, and they picked up stakes and left. And now there are two largely empty buildings in Stamford, Connecticut. No way is the suburbs ever going to replace the CBD for anything but a place you live.
Understood. And that's one of the reasons, I guess, you see companies like Google and Facebook taking so much space in that central business district, because they're trying to attract that top talent, and it's where the top talent wants to live.
Yeah, Loren, I would just say that's a great point. And Google is a client I've worked with, and I've been fortunate to see their office space in Silicon Valley and see what their plans are for Chelsea Market, and the fact that they've expanded their footprint in New York City, across 4 city blocks. So they anticipate hiring a significant number of engineers to fill those seats in New York, even though at the current time, Google is telling their people they can work from home, almost indefinitely till next summer. The reality is that Google had made a decision a while ago, and you can see it in the Facebook space as well. They've created offices that are so appealing. They have great food, they have great coffee, they have really interesting nooks for people to sit in and collaborate. And you don't have to be in a static office. You can literally move around a campus of 17 buildings and have a different kind of food every day of the week if you want to in their campus in Silicon Valley. So it really is, and PwC, followed that model to a certain extent. Our office redo in New York incorporated coffee, specialized coffee bars. We created interesting communal workspaces. We created great places to go eat your meals or to relax and sit by yourself if you want to be on your own or be working with your fellow colleagues. So I think I agree with Spencer. The notion that people will move out to the suburbs, it's all about the war for talent. And the talent wants to be, especially young talent, wants to be in an energetic setting. They want to be with other people who are ambitious and want to advance in their careers. So whether it's Silicon Valley, whether it's New York City, there are places that are going to be talent magnets, and the office of the future has to reflect the kind of place that talent wants to be and wants to spend a lot of time, because they're going to spend a lot of time there. So I think that's a trend more so than the bailout to the suburbs for commercial office space. I think we can talk about residential. That's a different ball of wax, but commercial tenants, attraction of the best talent. You want to have great office space, and you want to be in the cities.
And I think I would just add to what David was saying, that it's not a very straight calculation as such that, okay, people are working remotely and we just we do some math around what's the cost of getting people back in office. I think there's also a huge infrastructure cost associated with people working from home. And if companies decide to take a virtual a hybrid version where they have few people working from home and a certain population coming back to office, they'll also have to weigh in the whole mess of maintaining 2 different sets of infrastructure. And along with that, how would they continue to maintain that office culture in a hybrid environment? So many organizations have taken a while to adapt to this whole virtual work environment. And we saw it in the poll that people want to have that human connection, go back to office. So figuring a method to that madness as to what works for a particular company will take its own time, and companies will have to evaluate the whole infrastructure cost of maintaining a hybrid work environment, and whether to what extent would it really make sense to continue in that environment, especially after we have the vaccine.
And this is just an observation. If you've ever actually checked on Google and you can get the, you know how much square footage they lease, and you can actually Google how many people they have employed in their company, you find out that they are anything but dense. They are the opposite of dense. They have more than 300 square feet per person. So it's all, I think you're right. If in the war for talent, it's about making a workplace that people want to come to.
That actually brings up another question. Actually, the poll answer, 57% of those who responded said dividers between employees, touchless doors, and so on is really what would bring them back into the workplace. We've, over the last, 7 or 8 years, really compressed the square footage per employee. Are you thinking we're going back to a larger footprint per employee?
Well, again, if you have a vaccine, will the barriers go away to a certain extent too? I mean, companies densify because they need to reduce costs. It's not, and I think they can talk about all that other stuff, but really what it boils down to is they need to occupy space in the most efficient way possible. So I don't think that'll change.
Sarah, anything to add on your side?
Yeah, I mean, I think employees are certainly going to have an expectation that their, health and best interests are being looked out for in going forward in the office. And so there's certainly going to be a heightened focus around, health concerns, employee well-being, wellness, and things like that. And if we are shifting to a more hybrid model of, work from anywhere combined with the office being either a touchdown space or a collaboration space, I think we have yet to see how that's going to shake out in terms of whether that's space reduction or space growth. It could really go either way there. So I think those are trends that we'll need to see play out as we move forward, but certainly workplace strategy, workplace design is going to be at the forefront of this return to work movement.
We did a panel a week or two ago, and several brokers were talking about trying to get space leased in the Manhattan marketplace and the type of incentives they were giving away. I think it was Tara Stakem who said that they're seeing some leases or maybe it's Craig Lemley saying that we're seeing some leases that are giving as much as 17 months rent abatement in order to get a tenant in, which is just astounding to me. What are you seeing in the marketplace?
I mean, that's in Manhattan right now. Manhattan hit this at a very inopportune time in terms of its own cycle, right? So for the first time, we entered a recession with a vacancy rate in double digits. We haven't seen that. Maybe in the late 80s was the last time that happened. So yeah, even before COVID hit, landlords were increasing incentives dramatically, and this only accelerated that.
Yeah, with the addition of so much sublease space coming back, as well as, companies putting space back directly, there's just going to be so many options out there for tenants. It's going to be incredibly competitive across nearly any market that you're looking at. So the concessions are going to follow there, as well as reduction in those space rents too.
Yeah, I think the other thing, Loren, talking specifically about New York, you have a significant amount of new space that's coming on stream in Hudson Yards. I can't remember the last statistic I saw, 17 million square feet, of additional space coming into the market. I mean, that is kind of, I hate to use the term giant sucking sound. Those of you who remember Ross Perot, if you're old enough, Hudson Yards has been kind of this gigantic pull away from 6th Avenue and other places. But what worries me in the near term is that there's a lot of new space that has to be taken up. There is sublease space that's being put on the market, although hopefully that's a shorter term phenomenon. But we are looking at increasing vacancy rates in Manhattan. It's the absorption is not keeping up with the completions. So it is going to be a depressant on rents in the near term for office. It just has to be.
How much sublease space are you seeing coming into the marketplace? Sorry.
Sublease? I don't have the stats in front of me, but I mean, in New York, it's something around 20% of all the available space is sublease space right now, and it's going up. So it's, you know, as you said, the new construction is attracting the tenants, and what we always had to have and what was always expected was you'd get the job growth that people wanted to live in New York and would come in. And, you know, nobody, you know, as we know in real estate, we always build the most just at the end of the cycle. Nobody anticipated the downturn.
Mm-hmm.
And, you know, eventually it'll probably get absorbed as job growth returns, but it's just going to take longer.
It's interesting. I did an event back in 2006 in May, and we had one of the panelists told me we'd never see another real estate recession because there's arbitrage in the market now, and we have so much data that can never happen again. It's kind of funny when you look back at some of the things that experts come up with over time.
You're not going to tell us who that panelist was, are you?
I am not going to tell who wasn't there. Not with us right now. So.
Well, I think we benefited prior to COVID. You know, again, we had large space users like Google, like Facebook, like WeWork that were absorbing a lot of space, taking a lot of Manhattan office space. And you know, I hate to say it, but you know, I don't know that Google is going to continue to expand the way they have. I don't know that, you know, Facebook has signed 2 large leases. Don't know that they're going to be in the market for more space. And WeWork, as we all know, is really not in the greatest position to, you know, if anything, they're going to be potentially giving back space, not adding to it. So our you know, the last few years, in addition to normal demand, we've had some unusual demand, certainly in New York. Those tenants aren't necessarily adding, and in fact, maybe subtracting. So
let me touch on that last point, David, if I might. And by the way,
yeah, go ahead, Spencer.
David's PwC report is fantastic. So don't take my negative survey comment the wrong way. It's fantastic. I read it myself. But I want to touch on co-working and flex space because David touched on it. It also was in the chat room just now. And let me just say that the future of flex space is bright, very bright, even though at the moment it's bleak. And it's bleak in the major cities because people can't get there and they have high density. But when you take a look at the usage of flex space in suburban locations, very, very high usage right now because people need a place to work. And now I'm going to go to a survey we just did. A survey we just did shows the #1 amenity that large corporate occupiers want going forward is flex space in their building. They want to have the ability to have that additional conference room or other collaborative space in or near where they're working right now so that they can take a smaller permanent footprint because subleasing has been the norm forever, but subleasing is extraordinarily inefficient. What is efficient is taking less space and having flex space in your building. Now, there's some users who can't go do flex space. So I had an interview last week with the CEO of a large REIT in the Washington area, Corporate Office Properties Trust. And his tenant base is mostly military and government. They can't go to flex space because they have security concerns. I did a piece on CNBC a few weeks ago on biotech. They can't go to flex space. They can't even work from home because they're in labs. So there'll be certain types of users that cannot use this flex space, but most can. And I think you're going to see an increasing amount of it. What's going to hold it back in the short term is not only the density COVID-19 issue, it's the capital markets. Because right now the capital markets, particularly the lending community, is giving limited value to flex space. So what they'll do is they'll get a building that is, say, 90% lease. And if it's 20% to a flex provider, they'll carve that 20% of the capital stack out of the building. And you will get no credit for it. And there are some equity providers or equity buyers who are doing the same thing. So in the short term, flex space has a capital markets problem. But in the long term, the occupiers are going to drive its demand.
Do you think with that flex space coming back into the market that we're going to see more of the large landlords rather than a WeWork type setup where they're leasing space then subleasing it? whether the SL Green model or one of the large corporations that owns the buildings are more likely to be successful with that model?
Well, the short answer is that there are a lot of operating businesses that are now being purchased by traditional landlords all across the board. It's in retail first and foremost, where the Brookfield and Simon bought Brooks Brothers, the J.C. Penney, and we can go right down the list. And so where does the line end between who is a landlord and who's a tenant? And the reason why we have this traditional split between the two is just math. And it's not as complicated as you think. Because what is a 5 cap? 5 cap is a 20 times multiple. That's what it is. And you can't get a 20 times multiple on most operating businesses. And so the reason why people want to be more like a traditional landlord than an operating business is you get higher value. Now, there are exceptions to that. I had on my podcast the other day the CEO of Equinix, which is the largest owner of data centers in the United States, and probably in the world, frankly. And I asked him a very point-blank question. Are you in the real estate business or are you in the technology business? And he was very specific about being in the technology business. Why? Because the technology business is one of those businesses that gets a higher multiple than real estate.
Yeah, I would just like to add to one of the points that Spencer made about, how are people really valuing property? I think that itself would go through a fundamental shift over the next 18 months or beyond. Like, it's not just going to be looking at, like, for retail, looking at, like, say, sales per square foot. How are you going to use more data and different factors that will have an influence on value? So are you looking at the experiential value of a property? We've been seeing this trend in the retail sector that with the growth in e-commerce sales, people are not going to a mall just to shop. It's all about the attractiveness of a mall really depends on the experience that we create in that mall space. I think the same trend is likely to build out more and more in the office space, because we've been talking a lot about how people are missing the human connection. We saw that in the poll question as well. So how are companies working? How are owners working closely with occupiers to understand what kind of experience would they want to create for the employees? And that will require companies to invest heavily in data, heavily in AI technology and similar stuff to make more informed decisions, more nuanced decisions, and not just look at traditional metrics. We've also seen this from the investor community, where they are placing increased emphasis on things like sustainability. So are companies, again, owners, focusing on things like sustainability, etc., when they are thinking of looking at leasing their space out or attracting investments? So I think there is a fundamental shift in the way how investors and tenants are going to value property going forward. And there is merit in looking at factors beyond the traditional ones that have historically determined the valuation of properties.
And that's one of the things that's driving the new construction, because you can do that best in a new building where you don't have to deal with the legacy issues.
Yeah, I think that's absolutely true, Ken. I think there is more of a focus on ESG. We've heard that from investors. Whereas in the United States, I think it really started in Europe before the U.S., but we are hearing much more focus from investors that they want to invest in properties that have LEED certification or have are congruent with their ESG commitments. So that is going to help new construction for sure, but it's also going to help the rehabilitation of older office buildings to be more have less environmental impact. That's a trend that's here to stay and is only accelerating. ESG or real estate is something that absolutely has to be on the mind of private equity investors, as well as anybody who's investing on behalf of large plan sponsors and endowment funds.
Yeah, in fact, in the pre-COVID world, in our last Outlook report, we actually mentioned about how traditionally, the real estate business has been about location, and how that's evolved very quickly over the past few years. And I think the COVID situation has only accelerated it as to how it's going to be more about location, analytics, and health and safety now. So I would say it's the shift is pretty accelerated due to the pandemic.
Is there any technology that we're looking at that are going to be built into some of these buildings that may help to alleviate this on the next pandemic? Because this is probably not the last one we'll experience.
There's lots of it already out there.
Yeah.
Part of it's touchless, but there's also HVAC systems that can both be new and retrofitting old. The new one, which is pretty cool, which a client of mine is building in West Hollywood right now, is hydronic HVAC, which instead of having forced air, they're pumping hot and cold water into their walls, into their floors, which does the same purpose without forcing air into your building. The other thing that people are doing, I spoke to the CEO of the Trammell Crow companies about this, they're doing more return air systems where they're actually using outside air versus inside air. The system that's most controversial is the one about using ultraviolet light, because notwithstanding the fact that it may kill the pathogens within the space, there's increasing evidence that it might be a carcinogen. So there's a yin and yang to everything.
True. Any other comments on that or thoughts?
I would say along with, the whole suite of smart building technologies is the one that's going to take prominence and can play a role in every step of building operations. Heavy use of technology in facility management, even things like 3D visualizations, which can help landlords assess operational readiness of physical spaces in real time, implementing more rigorous cleaning systems. Not just like implementing stuff to make places safe, but also use technology for continuous monitoring, be more preemptive with repair and maintenance needs. So I think definitely there is an opportunity for companies to digitize the entire facility management, the building design, and the user experience using different types of technology.
And I probably shouldn't add this because we've been talking about the pandemic, but with the impending likely change of leadership in the country, do you see that impacting what happens after this pandemic with the potential changes in 1031 exchanges, the potential changes in tax structure?
Well, I think we need to say what happens in January, because that'll be key. I'm one of those people who thinks that gridlock is good. That the less they can do, the better. But obviously, the new administration has laid out a plan. Whether or not they get to execute it will depend on who runs Congress.
Well, I think on that front, I spoke with the Real Estate Roundtable yesterday, and they believe that even in a 50-50 split scenario, where Georgia both seats go to the Democrats, you're not going to see any risk to the things that are most near and dear to real estate. Including the 1031 exchange isn't going anywhere. Carried interest tax is not going to be treated as ordinary income. You're not going to see massive new regulation. But there's actually a downside to it not being a blue wave. Now, I agree with Ken completely that split government is the best government from a business standpoint because it puts the worst impulses of the right and the left in check. It would have been better if we saw a much bigger stimulus package because state and local governments are broke. Let's just call it what it is. Now, I'm not going to sit here and say they had clean hands before this crisis began, because most of them didn't. But they're broke, and they need to find pockets of capital to replace the taxes that they lost. And who is Exhibit A? Yeah. Commercial real estate. And we dodged a bullet in California when Prop 15 failed, but we didn't dodge a bullet in Chicago where they're revaluing the buildings, and they're not changing the mill rate yet. But property taxes are risk number one because of a small bailout package. So blue wave probably would have been bad in the long term for business, but in the short term, it would have been stimulative and better for real estate.
Mm-hmm.
Yeah, and Spencer, we agree. There are cities like Nashville who just increased their millage rate 34%. People are off the wall, but it's a city that's growing quickly. Where's the best way to find money? Go to the commercial landlords and go get it. We did dodge a bullet in California, Prop 15. For those of you who don't know that, Prop 15 was going to repeal Prop 13, which put a cap on the ability of municipalities to raise real estate taxes for residential as well as commercial property. Prop 15 would have eliminated that cap for commercial real estate other than residential. So it really would have had a potentially very disruptive short-term effect on real estate. Even if you could pass through those increased real estate taxes to tenants, somebody would still have to pay the increased burden, and it would be potentially very disruptive. So we did dodge a bullet, but I agree with the panelists. We are looking at shortfalls around the country, and that's, again, fairly normal in a recession. State and local receipts drop off. States have to retrench. They have to lay off workers. They have to cut back, and that is, a drag on the economic recovery. So hopefully, in this new environment, there will be some stimulus. Hopefully, the Congress and the president, either before January 20th or after January 20th, will come up with some relief funds for the airlines. It'd be nice if they could find something for the hotel business or the restaurant business, or find some unemployment dollars for those people who are suffering greatly with the dislocation and the lockdowns. But it's hard to say that we're going to get a tremendous amount of stimulus, and whether we get any sort of tax stimulus, whether we get any fiscal stimulus. Unfortunately, I think the panelists are right that we are potentially going to see more municipalities looking to commercial real estate to help make up the gap, and that's depressing to real estate valuations in the short term.
It's also depressing to me. I own a bunch of it. I guess one last question, because we're running shorter on time, and I want to introduce one more subject real quick. But would any of you like to voice some additional thoughts on what will be the lasting impact of the pandemic on commercial real estate, and are there any sectors that you're concerned about right now in the near future? Why don't we start with Sarah?
Sure, I think we've touched on it a lot. Just my perspective is, that it's going to be, there will be a return to what was somewhat normal, as we move forward, and the vaccine's more available and better announcements there. But it is going to shift. People have been home, and we've seen that we can do this. We can work remotely, and there's been a lot of progress with distributed teams. So I think there's going to be more flexibility built into how organizations are using, that combination of work from anywhere as well as physical locations for their office. So going forward, I think it's a focus on how the office space is used, what those, layouts and purposes look like, but, we will get there.
Okay. Surabhi, and I apologize, Shannon pointed out to me that I used the wrong title for you. You're actually Vice President at Deloitte, so I apologize for that.
No worries, Loren. So yeah, I would say three areas. The first one is how do landlords and occupiers, how do landlords and tenants collaborate better with each other? The longer term success, again, would depend on more effective collaboration at every step of, leasing, designing, facility management, collaborating at each step, because there's going to be more and more focus on space design, like if we take office as an example or retail as an example. The second one would be around how companies really look at digital transformation. The third one would be the importance of empathy and human connection. I think that really is what people are really looking at spaces to draw those human connections, to really mingle with each other with, of course, right now the whole social distancing piece, but in the longer term, I think these are 2 or 3 things that will really make a difference. And I think from a property perspective, we've already discussed, I think it's more, there's likely to be more softness in the retail, hotels, to some extent in the office space in the near to medium term, and perhaps more demand for industrial, data centers, healthcare spaces, and even cell towers to some extent.
Thank you. Spencer?
Well, I hate to be the first person to disagree with a panelist, but I'm going to disagree with the very well spoken, but I disagree with the comments of the last panelist. And the reason why is this. We've studied industrial, data centers, life sciences, real estate, cold storage, all of the coolest kids in class right now. And while fundamentally they are all not only sound, but exceptionally sound, there's so much money that's chasing them right now, that there is an increasing chorus of people who believe they are priced beyond perfection. And so when you are a real estate investor, you have to keep in mind that following the money isn't always your best strategy. I mean, this is like a political comment because of the Nixon administration follow the money thing. Sometimes it's better not to follow the money. So 3 weeks ago, I was on record saying that REITs were the most oversold sector in real estate, and then they popped by 35%. It wasn't because I was Nostradamus. It was because it was obvious that people had thrown the cities under the bus too quickly. Much as people have thrown under the bus too quickly student housing and senior housing and some of these other subsectors and CBDs that are considered to be disfavored. The goal is to get the best risk-adjusted return. And we are about to price a $300 million portfolio in Southern California in industrial with a 2 handle on it. And that is that is a cap rate that is below European cap rates. And I had predicted that American cap rates were going to get to European cap rates. I did not predict that they would get below it. So I'm with the prior panelists, and I only say prior panelists because I don't want to mispronounce your name, which would be rude, because she's right. Those are great sectors, but the risk-adjusted returns may not be as attractive as some of these disfavored sectors.
Yeah, I would say from an investment perspective, it may be slightly different. This was more from a leasing demand perspective that we are going to see some of these, some level of uncertainty in some of these spaces over the next 6 to 12 months because they're so heavily dependent on the vaccine and outcome of the pandemic.
Ken?
Okay, I guess I'll start with overall, I think COVID has certainly accelerated certain trends, and that's going to have an impact on how job growth and how cyclical growth in the economy impacts the real estate sector. It's likely that we'll probably see some headwinds there that might not have been there before because now more people who add jobs may not necessarily work in an office. So when you add it up in the aggregate, what that means is probably less absorption per job than you've seen in the past. But behind that is, the big tailwind in the U.S. economy, in the office sector in particular, that's been going on for decades, is that our economy is becoming more office oriented. The jobs that are being created are knowledge jobs, jobs that require people to be in an office environment. So the share of total employment that's taken up by those office using industries continues to rise and will continue to rise. And what that means is that as we add jobs, we will absorb more space in the office sector. We'll eventually absorb all those new buildings. It's just going to take a little bit longer because of some of the things that are coming out of COVID.
Thank you. And David, I'll give you the last word on this.
Yeah, I don't really have a whole lot else to add. I think everybody's made some excellent points. The only thing I would say is, there is a tremendous need for affordable housing in this country. We haven't really talked about that today, but as an investable sector and a place where more money is needed, that's a sector that definitely deserves attention. I agree with the comments about data centers. It's just been remarkable what we've seen in terms of the money flow in that direction and the amount of new development going into that space. It is a little frightening to see that. And industrial is priced to perfection. I would say, again, look at retail reuse. Look at the call it the malls that have been past their prime. Those are going to have to be repurposed for new development. And so we may see more, whether it's healthcare or multifamily or affordable housing. I find that very interesting, opportunities to take real estate that's kind of past its prime and redevelop those. So I would say we need to look at repurposing a lot of real estate. The old comment is, the United States is retail is not overbuilt, it's just under demolished. We have to make reuse of the retail properties we have around this country. And I think there'll be a lot of creative redevelopment going on in the retail sector because we certainly have too much of it and need less.
Under demolished, I think I'm going to use that term. Thank you all. Before we close out our program today, though, I do want to introduce one other person. That's Michael Fife of Ladder Capital. He's going to introduce the Real Estate Alliance that helps us to foster connections for Lehigh University alumni in the industry. Michael?
Great. Excuse me. Appreciate the intro, and thanks everybody. It was a great panel, really informative. Glad I was able to listen in. As the professor mentioned, I'm a 2012 graduate of Lehigh and currently work on the originations team at Ladder Capital, which is a publicly traded mortgage REIT. Also the co-president of the Lehigh Real Estate Alumni Alliance. As a quick overview, Alliance provides social, business, educational, and professional network for alums working in the real estate industry with the goal of fostering new connections and advancing existing connections across the space. So from leasing, financing, banking, I think we have alums working all across the industry. Working with Shannon in the real estate department, along with the alumni office, we've hosted a variety of events, including a breakfast speaker series, guest speakers, touring new and under construction buildings in New York, and happy hour networking events. Of course, a lot of those traditional events are on hold right now, but we're looking to try to have a couple interesting events in the first quarter next year. Hope that some of you will be able to join. Always interested in new ideas or any guest speakers, ideas of events that you might have. Feel free to reach out with any suggestions to me, Shannon, or the alumni office, and hope to see you there.
Thank you, Mike. And again, I want to thank all of you for joining us today. Sarah Dreyer, Surabhi, Kejriwal, Spencer Levy, Ken McCarthy, and David Seaman. And I'd really like to thank Shannon Smith for setting all this up and for all the incredible work she does to make our events great. Again, I'm Loren Keim with the Goodman Center at Lehigh University, and we truly appreciate all of your support for our students, for our program, and for the research our faculty is engaged in. And of course, thanks for being part of our event today. This will be available for replay for anybody who would like to see it. And I want you all to have a great night. Thank you.
Thank you. Thank you for having us over.
Thank you.